Emerging Issues Program, the latest in webinars presented by Wilkin and Guttenplan for community associations. Before we get started, I have a few housekeeping items to explain. First, use the question pane in your GoToWebinar dashboard to submit any questions or comments you have as we proceed through the presentation. We'll either address them as we go, which probably makes sense given the number of topics and different speakers. If we don't get to it during the program, we'll answer them at the end. We're going to try to keep this presentation to 1 hour. We'll leave a little time at the end to answer questions. And at the end, there'll be a slide with the presenter's contact information if you want to contact any of them directly. A recording of the webinar, as well as a copy of the slides, will be placed on our website, which is www.wgcpas.com. You can also find recordings of past webinars there, along with other resources for community associations. You'll also note that the slides that we're going to use tonight have quite a bit of text, which isn't usually the best practice approach to doing PowerPoint presentations. But we do that because when this goes up on the website, it enables the viewer to not only listen to it, but also see some of the text directly on the PowerPoint slides. We encourage you to tell your fellow board members or colleagues who missed the webinar and for whom you might think it's worthwhile to view, to go to our website to see it. Also, keep your eye out for the additional webinars that we will have up and coming. We do these periodically throughout the year. And email us if you have any thoughts or comments about future webinars that you think might be useful or topics you would like us to cover. We're happy to do them either as a webinar or we can even do them as live presentations. And as always, we welcome your feedback both as to this program and to anything else that's covered in the context of this presentation. So again, please feel free to contact any of the speakers, or you can contact me directly. I'm Ed Guttenplan, your moderator for today. So I just want to go through the speakers so you know who everybody is. As we go through it, I'll introduce them now and then quickly turn it over to our first speaker. I am the moderator. I'm Ed Guttenplan. I'm the managing shareholder of Wilkin and Guttenplan. Our firm does somewhere in the neighborhood of 700 to 800 community associations throughout New Jersey and New York. It's one area of many areas of the firm that we specialize in. Today's topic in particular, we were able to bring some of the people from our corporate tax department to speak to some of the issues related to co-ops. And that brings me to Vinay Navani, our second speaker, who is the head of our tax department. Vinay is a CPA and an MST and a GD, which is a good guy, sorry, GG. Next we have Arlene Stern, who's the president of 1530 Owners Corp., which is a co-op in Fort Lee, the Colony. Arlene has been a president of that community for about 5.5 years. Prior to that, Arlene has a wealth of experience. I think it's 30 years in corporate America, including her last position that she retired in, which was the CEO of a major publicly traded retail company. Next, we have Len Nitty and Stephanie Holston. Len is a manager in the tax department of Wilkin and Guttenplan, and Stephanie is a senior accountant in our tax department. Both top-notch team you'll hear from on some tax considerations. We are presenting the section on reserve studies being presented by Mitch Frumkin, who's the president of KibCon Inc., which is an engineering consulting firm, and who also specializes in both residential, commercial, real estate, reserve studies, energy consultations, green buildings, and so on. And Mitch has a lot of great expertise to bring to the table. And lastly, batting cleanup is Carol Karansky, a senior manager at Wilkin and Guttenplan in our Sierra department. And Carol has also had a great deal of experience in community associations. So without further ado, we're going to jump right in and be stimulated by Vinay going through the tax aspects. And again, most of this is designed to capture some of the emerging important issues and things that sometimes fall under the radar as it relates to co-ops. Vinay?
All right. Thank you, Ed. We're going to start out with the most exciting part of the presentation, in my opinion, sales tax. So let's frame the conversation before we get started. A co-op really is wearing two hats with respect to sales tax. One is the co-op has transactions with its residents where the co-op is the seller, so to speak, and has to collect sales tax from those residents and remit it to the state. On the other side, the co-op is a purchaser of goods and services and is the payor of sales tax. And it has to use a different set of rules when it focuses on those transactions. So we're going to be talking about both of those today. So why is sales tax compliance so important? Well, especially where the co-op is the seller of goods and services. What will usually happen in the case of an audit is the state will not come to audit you until 2 to 3 years after the fact. And if you should have charged sales tax on something from a resident, and you did it timely, you would simply collect it from the resident and pass it through to the state, and it would not be an economic cost to the co-op. If you wait till audit and the state comes back to you 3 years later, it's virtually impossible to go back to the users of those goods and services, and it ends up becoming an expense of the co-op. So that's why it's very important to be on top of these issues. You know, probably 10 years ago it was unheard of for the state to audit a co-op. Now, you know, I'm not going to say it happens every day, but it does happen. And we've seen a number of them in our office. So on sales tax, the basic framework is we have a tax of 7%, and the tax is on sales of all tangible property unless a specific exception applies. With services, it's the flip, that services are generally not subject to sales tax unless they are specifically enumerated service. And of course, it's the responsibility of the seller, in this case the co-op, to collect and remit sales tax. The flip side of sales tax is something called use tax. The rules are all the same, but if the seller fails to collect sales tax for whatever reason, the responsibility for that tax shifts to the buyer. So that's use tax that we'll be talking about in the presentation. So what are some areas of concern for sales tax for co-ops that we see? We see health and sports club membership fees, storage units, which we'll talk about, parking, security, and in-unit repairs and maintenance services. Health and sports club fees is probably the most common. If a typical scenario will be a co-op will have a pool or a gym, some sort of health club, and unless the use of that club is rolled into the monthly maintenance fee and is really available to everybody, it is subject to sales tax. And the only principal exception is what they call the participatory exception, meaning that if I want to, instead of being a member of the gym in the co-op, if I want to pay $5 to work out for a day, that $5 fee to work out for that one day is not subject to sales tax. But once you get beyond that, any sort of fee to allow me to use that gym or use that pool is subject to sales tax. The co-op has to collect that from the residents. Now with storage units, there have been some mixed signals coming from the state as to whether if a co-op had storage units, whether those were, if they allowed residents to rent, usually on a monthly basis or an annual basis, whether that was subject to sales tax. And actually, just a few days ago, we got pretty good confirmation from the state that they've backed off on this position. There was some question as to whether a co-op was engaged in the business of furnishing space for storage in the same way that a self-storage place would be. We never thought it was, and now the state seems to have finally conceded that it's not taxable. Security services are one of those services that are subject to tax. And so you have to be aware of that. Two ideas are, to the extent you use your own employees rather than a third-party security firm, that will take away the sales tax hit. And also, sometimes a person who is at the front desk doing what's arguably security is also doing a number of other things, helping residents, and maybe sometimes a concierge can be a more appropriate title. You have to look at the facts and circumstances as to what that person is really doing and seeing if there's enough of a position to depart from the state's definition of security while adhering to maybe some municipal requirements of having 24-hour coverage. Parking is another area. The general rule is that fees for residential parking are exempt. Two areas that could come up we don't have answers to, but I would be cautious about, is if you have guest parking fees, especially if they're paid for by the guest, and some co-ops that we know will have a valet parking arrangement where there's valet parking fees. We don't have any guidance yet on the state on those transactions. Now, if we put the use tax, what are some areas of concern that we see with co-ops? Well, out-of-state purchases is always a big one. To the extent the co-op purchases office supplies, pool furniture, any type of tangible goods from out of state that if they purchased it at a New Jersey retail location would have been subject to sales tax. If it's not charged, if the vendor is not charged sales tax, the co-op needs to pay use tax. The next four bullets, repairs, installation, maintenance, and landscaping, are a taxable service, and let's talk about that next. For these types of services, it's subject to sales tax. The tax is really on the labor portion, so it's important to make sure that the vendor separately states the parts component of the invoice. If they don't, the whole item is subject to tax. And this is an area of frequent noncompliance, whether it's because the vendors aren't aware of their requirements or they somehow think the co-op is exempt. I mentioned very briefly in a previous slide in-unit repairs. If a co-op has its own employees who are doing work inside a residence unit, perhaps fixing a faucet, changing a light fixture, whatever, and it's separately billed for and paid by the resident, the co-op is probably standing in the shoes of a service person or repair person and probably has to collect sales tax on that transaction.
Today, just as a point of interest, we're engaged in an audit right now by the state on that very same issue, the in-unit repairs, and the state auditor has given us a list of all the charges to the units that they want to collect sales tax on.
Okay.
And fortunately, this client, thanks to our guidance, has been collecting the sales tax on it, but the state is right on it.
Yes. Okay, thank you, Ed. The other important area in the world of use tax is capital improvements. I put the definition of capital improvements on the screen. I've been involved in audits where an auditor will look at a light fixture and try to assess, could I remove this light fixture from the wall without damaging the light fixture or the wall? Or is it so integral to the real property that the capital improvement? It is a subjective determination. If it is considered a capital improvement, there's no sales tax. And if you come to that conclusion, there is a Form ST8, an exempt capital improvement certificate that the co-op will issue to the contractor to allow the contractor not to charge sales tax. Two important exceptions to that general rule are for flooring and installed security systems. Even though they will meet the definition of capital improvements, those two are specifically carved out in the statute as being taxable. Now, if you've heard things in the last few minutes where you think there may be some sales tax exposure or use tax exposure, the state has a wonderful program called voluntary disclosure agreements. And the premise is the state wants you to come to them before they find you. And the key is that you cannot be registered for sales tax. So if your co-op has never registered for sales tax, it's possible to go to the state on an anonymous basis. And the real benefit of the VDA program is that you're going to pay your tax for the current year and the prior 3 years. But in theory, if you never filed a sales tax return, the state can come back forever. In practice, they go back about 7 years. But if you come forward, you get about a 3-year look back. So it's a great opportunity. So let's summarize some of the best practices for co-ops. You want to look at all your invoices that you pay, make sure they have sales tax, or if there's an exception, document on the invoice why there's no sales tax charged. If there should have been sales tax charged, pay use tax. If you don't have any sales or use tax liability, you have the ability to file an annual business use tax return. And by doing that, the benefit is you're starting your statute of limitations. You can file it in showing no tax due, and it will still start the statute. And it's due May 1st, so you still have a few days to get them in for 2010. Look at your capital improvements. Make sure that you're comfortable that they do meet that definition for capital improvement treatment. If it's unclear, you can write to the state for guidance, or maybe you'll take the position that you're going to keep the use tax on that capital improvement in reserve in case the state were to come back and challenge you. Keep all your estimates that you issue on file. Keep other evidence to show that this project was really a structural project, or blueprints, permits, things that show that it's not a repair. So that takes me to the end of the highlights of the sales tax portion, and now we're going to turn it over to Arlene.
I just want to interject two things. First, if you're a board member, you should be inquiring as to whether your managing agent is actually taking care of the sales tax aspects of your community or your building. It doesn't always happen, so we encourage you to ask your manager whether, in fact, they are collecting sales tax or paying use tax. The second thing is we often get used to seeing sales tax charged in all the invoices we get in for services and repairs, and then we don't become attentive to those that slip through that don't have sales tax on it. And you could be processing many invoices during the course of a month, and then you get one from an out-of-state vendor for supplies or for computer equipment, and you don't realize that sales tax were not charged. So somebody has to be attentive to the invoices coming in, and whether sales tax have been charged has to be on every invoice. So again, it's up to the boards to make sure the managing agents are doing it, and for the managing agents, it's your responsibility to make sure there's a process in place to capture the preparation of the sales tax return. So now we'll turn it over to Arlene. Thank you.
Thank you. It's a pleasure to be here. I appreciate the invitation. As I said, I've been on the board for about 5.5 years, and I know when I first got involved with the board of my co-op, there was a long learning process. And for me, having come out of the corporate world, that helped. But people run for boards for different reasons and bring different backgrounds. And while that's great for a diversified board, it leaves open the opportunity to also have to do some training and to give a better understanding of what the responsibility is of board members. So having said that, to me, we're still a corporation. We may be a co-op, we may be a residential building, as are all the other co-ops, but we still have a responsibility as an officer or as a board of a corporation. And one of the primary focuses of a board is to increase shareholder value. And doing that in a co-op it's a little bit interesting because you don't have public stock trading, but there are ways, and part of what a board is responsible for is looking at how to do that, which in many cases for a residential building is translated to what kind of price as a shareholder do I get when I sell my apartment compared to what I purchased it for. Financial oversight, whether it be oversight of spending, capital, operations, is the second, what I believe to be the most critical responsibility of a board. You'll hear more from Mitch on capital reserve studies, but understanding what your long-term obligations are with regard to capital and what you need to have in reserve, both for capital and operations, and things like signing and spending limits and authorities. Who should be signing? Who has the liability? What are the checks and balances like any other corporation? When you talk about things like policy development and procedures for implementation, in many cases you may have a managing agent. In some cases you may be self-managed. But the actual policy development falls as a responsibility of the board. Your manager of the building may be responsible for implementing things like house rules, but the board has the responsibility to make sure that the house rules are applicable, that they meet any legal standards, and in many cases you need to be asking questions as a board member because laws are changing and you may not be focusing on it because you're not looking specifically at a housing market or you're not aware of it. Strategic planning sounds like a strange word in a residential building, but I use this analogy. If you were driving from New Jersey to Maine, you would take out a roadmap. Managing anything, whether it's a building or a co-op or finances, you need a strategic roadmap. And to do that, your board has to be in agreement. Where are you today? And where are you trying to go? What are you trying to accomplish? Which then brings you down to a periodic evaluation of performances. We all do audits. We have Wilkin and Guttenplan come in and do an audit, but we don't always audit the performance and the strategies and the implementation or the satisfaction of our shareholders. Building corporate culture. I mean, we all think of that as a word that's bandied about in a corporation, but who are we trying to be? You hear words, I know in my building here, we're a white glove building or we're a high-end co-op, but is everything that you're doing consistent with what you say you are or want to be? So clarifying the role of the board. How do you get new board members because there is turnover on a board? How do you familiarize them? If you are the person who stays on the board, or if the board is constantly turning over, how do you do that? How do you educate them? In our case, just as an example, we put together a book of key documents, everything that a board member should know. They actually have to sign for the book when they're elected to the board. They return it when they're off the board. And we actually do some training to familiarize people so when they get on a board, they understand what kind of documents can help them make decisions, what kind of documents they need to know legally, and what they have to understand. They don't have to be experts, but they have to have a familiarity. We require all board members, and by the way, committee members as well, and I'll talk to that in a few minutes, we require all of them to sign ethics resolutions with having to do with conflict of interest and confidentiality. Where possible, you can engage others in training the board, members in areas where expertise is needed. You can have Mr. Guttenplan come in and do training. We just talked about in our building having our attorney do some training when we do admissions, what you can ask, what you can't ask, what you should be familiar with. But give some training. They can be 5-minute training sessions. They don't have to be hours. You can do it periodically, but give some training to the board so they understand what they can and can't do as a board member and what their legal as well as ethical as well as operational responsibilities are. Things like how to read a P&L. Before we started this, I was saying to Ed, we have a psychologist on our board. He brings great expertise on a lot of subjects and makes for interesting discussion at a board. But he asked for some training on how to read a P&L because that's not the background he comes from. Understanding your legal responsibilities as a board and things like I mentioned earlier about admissions. If you're going to use committees in your building, which many of us do, determining the needs for the committee. What are the pros and cons of having a committee? Most of us may have bylaws that designate what committee or committees we have. But think about your admissions, your finance, engineering, house committees, social committees. Are they required? Are they needed? What do they do? And by what role do they have? And what are they responsible for? Remember, even with a committee, the ultimate responsibility goes to the board. So if you're designating committees, you need to understand that that doesn't transfer responsibility.
Arlene,
Yes.
often we see committees think they're empowered to make decisions on behalf of the board. How do you address that issue with the committee?
Very carefully. We actually have committee rules and regulations, and we asked every committee to participate in writing the initial step when we did it. We have, similar to the board but slightly different, we have no conflict of interest rules and ethic rules for committees. And in those rules and regulations, we're very clear that it is the committee can recommend, but the board makes the decisions. They're advisory. They're not decision makers. And we also have a liaison from the board. They're not a participant on the committee, but for every committee, there is a board member who's the liaison that is at every meeting, or almost every meeting, and participates in the agenda. And they send, call it, for lack of a better word, messages to the committee saying the board would like you to look at the House rules if it's a House and Grounds committee. The board would like, we redid our admissions application. We'd like you to look at the admissions application and give the board recommendations. But we're very tough on what the role is, and that ultimately the board will make the final decision. what I think people have to remember is there has to be interaction between the committee, and the board, which is why we use liaisons. And the board and the committee have to understand, if you look at your insurance policies, if you look at the legal ramifications or the operations, that when you appoint committees, almost by default, they're representing the board. And most insurance policies, and if you don't, you should, cover your committee members, but you also have to understand that if they do things that put you in liability, to Ed's question, which is how do you control it, that ultimately has to be controlled by the board. One of the things that I think there's a great opportunity for, whether it's through other community organizations or through surveys that people like Wilkin and Guttenplan do, is to participate and disseminate information and best practices. Where do you stand up compared to other similar-sized buildings on expenses? What can you learn from policies in other buildings? Your energy and utility usage compared to a similar-aged building or a similar-sized building. Your pay practices, particularly if you're non-union. Equipment maintenance, services provided, security, and there's a whole host of others. When we're looking at a policy, one of the things we try to do is reach out to other buildings so that we can learn from other buildings what we may not be doing and what the best practices are. How often do we conduct management audits? Prior to us starting, I was saying to Ed, we all do financial audits, but do we do operational audits? We need to look at the frequency. How often should we be doing it? And what is it we're trying to audit? Do we look at our co-op or condo and say, how many services are we providing? What's the level of service we give to our shareholders? Remember, our primary goal is to increase shareholder value. Do we have the appropriate maintenance schedules? Do we have operating manuals in case of emergency, like a tornado that they were predicting today? Do we have record retention policies, best payroll practices? I mean, there's a long list. This is not meant to be all-inclusive, but how are you doing? How are you faring? Do you know how you fare on a financial audit? Do you know how you fare on an operational audit? If it's the board's responsibility, is it the managing agent's responsibility? What are the legal ramifications? How to get the best counsel? Where to use engineers, investment advisors, staff? There are a lot of people that are available to counsel and give advice in the performance area. It is a company. It is a corporation, and managing that corporation is a serious responsibility. And as a board member or as a board president, we all have a responsibility to manage it well.
Thank you, Arlene. Now we're going to have the Bonnie and Clyde of the tax world. This dynamic duo is going to bring you some critical tax considerations. So we turn it over to Len, Minnie, and Stephanie, and we thank you, Arlene, for your contribution.
Thank you, Ed. As you mentioned, Stephanie and I will be presenting some of the unique tax aspects of a cooperative housing corporation. While you're likely familiar with the great benefits of co-op ownership, such as the pass-through of mortgage interest and real estate tax deductions, it's important not to lose sight of the basic requirements for being classified as a co-op, so that these great benefits can be maintained. There are 4 criteria that a corporation must meet to be qualified as a co-op. The first is that the corporation can only issue one class of stock. Second is that the stockholders' ownership must entitle them to live in the unit pursuant to the proprietary lease. Third, the corporation cannot make distributions to any shareholders except out of profits or in liquidation of the company. And the final criteria is a 3-pronged test, and it's gotten a lot easier in the past few years based on a regulation change, and now you only must meet one of these 3 tests to qualify. The first one is that at least 80% of the corporation's gross income is received from the shareholders. Second one is that at least 80% of the total square footage of the property must be available to the owners for residential purposes. And the final is that at least 90% of the expenditures of the corporation must be for the benefit of the shareholders. Now that we've reviewed the qualifications for co-op treatment, let's move on to the first of the unique aspects of co-op taxation: patronage and non-patronage income. As some of you may be aware, co-ops are subject to tax on 2 parallel sources of income: patronage and non-patronage sources. we find that many co-ops are not in compliance with these rules through our review of tax returns prepared prior to our working with the co-op. Income from patronage sources is the income that a co-op receives directly from its shareholders, such as maintenance assessments and parking fees. Income from non-patronage sources is the income that a co-op receives from third parties, such as commercial rents and antenna income. As the income is considered separately for tax purposes, so are the expenses that go with them. Expenses relating to the tenant shareholders are deductible against patronage income, and any expenses relating to income received from the third parties are deductible directly against the non-patronage income. It's important to note that a net loss incurred from one source of income cannot be used to offset net income from the other source. Stephanie is now going to continue our presentation by focusing on the tax treatment of maintenance assessments for the co-op.
Thanks, Glenn. Another one of the unique aspects about co-ops is the way that a co-op allocates payments it receives from the owners between what's considered to be taxable income and what's considered a capital contribution. Now, the reason why it's important for a co-op to properly allocate its maintenance fees is for two reasons. First, it's going to allow the shareholders to increase the basis in their shares. And secondly, for the co-op, it's going to allow them to decrease the income that they pay tax on. Now, the portion of maintenance fees received that gets allocated to paid-in capital rather than taxable income is equal to the amount of principal payments that the co-op makes on its mortgage and any amounts that the co-op allocates to a replacement fund it might set up. Again, it's beneficial for the co-op to allocate these amounts to paid-in capital because it will allow them to maximize any net operating loss that it will have during the year. That net operating loss can then be carried forward, and it can offset any taxable income it might have in the future. Switching to more of an individual shareholder level, the way that a shareholder of a co-op calculates the basis in their shares is very different than someone who owns a piece of traditional real estate would calculate their basis. Because an owner of a co-op actually owns shares in a corporation rather than a physical piece of real estate, they're going to need to adjust their basis for the items that we just talked about that get passed through from the co-op to the individual shareholder. Now, the reason why the shareholder should maintain a record of these basis adjustments is when they ultimately sell their shares, hopefully, and make a gain, it will reduce this gain so that this will reduce any tax that they might have to pay on the gain. So in order to calculate basis on your shares, the first piece of information that you would need is your original basis, which would just be the amount that you originally paid when you first purchased the shares. And the basis adjustments that you would make to this amount are communicated to the shareholder on an annual basis via a letter that they would receive from the co-op. And what this letter is going to communicate to the shareholder is, on a per-share basis, what the principal payments on the co-op's mortgage were and the amounts of any allocations to the replacement fund that were made. The shareholder then can use this per-share amount to calculate the adjustment to their basis, just using the number of shares that they own. One important thing to note is that this calculation of basis would be different if we were talking about someone who owns a rental unit versus a principal residence, because there are adjustments that would need to be made for depreciation. Now I'm going to turn things back over to Len. He's going to talk about some of the tax benefits for energy efficient improvements.
Thank you, Stephanie. As Stephanie mentioned, we're going to move the discussion to tax credits that are available for these energy efficient improvements. And there are two main types of these tax credits available. One is the residential energy efficient property credit, and the second is the non-business energy property credit. For both credits, any qualifying costs are passed through proportionally to the shareholders so that the credits can be taken on their personal returns, very similar to the treatment of the mortgage interest and real estate taxes. The residential energy efficient property credit is designed to partially reimburse homeowners for their purchase of alternative energy equipment. The most common type of this alternative energy property is going to be the solar electric panels that you see installed on the roofs of a lot of co-ops and condos. Homeowners are entitled to a credit for 30% of the qualifying cost of the equipment. There are some limitations on the amount of the credit for certain types of property, is important to note. The second credit, the non-business energy property credit, is for energy efficient improvements made to a residence. The common types of this qualifying property includes windows, furnaces, hot water heaters, and air conditioners, assuming that they meet certain energy reduction standards. This credit is not quite as friendly as the residential energy efficient property credit in that there is currently a $500 lifetime limitation on this credit. And the calculation for this credit varies, as sometimes it's calculated as percentage of the cost of the improvement, while other times there are specific dollar amounts assigned to the credit based on the type of property that's being installed.
And I just a question for you. I've been involved in these in non-co-op situations, and one of the issues, and maybe you can comment on this, is in this case the co-op would have to spend the money to make the solar improvements, and then the credit passes through to the individual shareholder. So if there's a shareholder who for some reason isn't going to benefit from the credit, I'm just thinking about their lifetime credit, that shareholder is not going to be crazy about being assessed for the building to make that improvement, and he's not going to, she's not going to get a credit. Yeah.
You're right. There.
Can't use it.
Right. You're right. If they've already used their lifetime $500 credit, there's not going to be any benefit to them outside of, reaping from the benefits of having the more energy efficient types of appliances or windows or whatever it may be in there. So there will be some benefit, but they're not getting that initial upfront benefit that many of the other shareholders would be entitled to. And you're right, they may not be quite as excited about paying a special assessment to install these products. So that's a good point. Moving to the final topic on our agenda for today is the conversion of a co-op to a condominium association. I'm not sure how many of you have actually considered this in the past or are currently considering it, but it's important to note that we find when it comes to these conversions, many boards are not properly informed prior to making the final decision to convert. The promoters for these conversions often just focus on the positives, such as a potential increase in fair market value, but they often fail to inform you of the potential income tax costs of the conversion. Factors that you should be aware of when you're considering these are items which could lead to a tax liability for you. And some of the things that may lead to a tax liability are if you have a lot of owners that don't use their unit as a primary residence. It's going to be your rental units, your investment units, anyone who's using this as a vacation home or a secondary residence. Any units like that could be problematic and lead to paying some level of tax for the co-op, and it's really important to understand this before making the final decision. That being said, there are many positives and negatives to considering a co-op to condo conversion. Two big reasons that a co-op may want to consider a conversion to condo are the potential increase in fair market value to the ownership as a condo versus the current value as a co-op. And the second, the current low property values out there will help to limit any potential tax liability that you may be subject to. So those are two very big positives right now. A few reasons against the conversions. If you have a lot of the non-resident shareholders, as I said, this could lead to potentially paying some taxes, so you really need to be careful with that. And these conversions can also become very difficult for the shareholders to finance, especially considering the current banking conditions. All these shareholders are going to need to be able to refinance their mortgage, to make a contribution up to the co-op to pay off any existing debt that the co-op has on the building, and then converting it to a loan against the condo unit that they've received from the co-op. And the third, which may or may not be applicable, is a lot of the towns and cities we're seeing are considering reassessing these units as condo units now. They're going to be increased in value, and this will lead to higher property taxes for you. So you also need to be prepared for those higher property taxes. So I guess to sum the co-op condo conversions up, if you're considering it, it's important to talk to your tax advisor here at Wilkin and Guttenplan just to make sure that you have all your facts straight and you can make a well-informed decision as to whether or not this is a good decision for your particular co-op. That concludes our portion of the program. Thank you all for listening. And I'll turn it over to Mitch for his discussion on using the reserve study to reduce energy costs.
Thank you very much. This is Mitch Wilkin, and I'm going to be talking about the reserve study and its relationship to energy and the overall costs associated with the association and their operation of the buildings. When Arlene first spoke a few minutes ago, she mentioned how critical it is for associations to have a reserve study so that the association and the Board of Trustees can meet their fiduciary responsibility to make sure that enough money is set aside that when it comes time to replace things, that money is available. The other thing she mentioned was, and she talked a little bit about, was the performance of the people who operate the building. What I'm going to be talking about is not how you prepare a reserve study, although I will show you what a reserve study looks like, but I'm going to be talking about how the reserve study can be used as the starting point to help you to establish the best performance of your building, not necessarily the people that work there, but making your building operate as well as possible and to minimize the cost of that operation, so the performance of the building. One thing I'll also mention as a fact when it comes to this type of thing is that in a typical association, if you look at the overall operating budget, about 70% of that budget is comprised of the cost of reserves, the cost of energy, and the cost of maintenance. So when a typical association puts together their budget each year, they may take the reserve study to put the amount of money for the reserves in the budget, but generally what happens is when it comes to energy and maintenance, they plug in the historical information from the prior year and don't look at the relationship between the three and see how they affect each other when it comes to the performance of the building, which is something I'm going to talk about. But as a starting point, I just want to show what a typical reserve study looks like without explaining how it's put together. But this is a typical reserve study, and there are two parts of a reserve study. One is the physical analysis, and the other is the financial analysis. What you're seeing is what most of all of you are familiar with when it comes to reserve study. It just lists each of the components that make up the community, how much it's going to cost to replace them, when they need to be replaced. So you come up with how much money you should set aside each year so when it comes time to replace them, you have enough money to do it. The second part of the reserve study is what's known as the financial analysis. The financial analysis is just taking that reserve study and doing typically a 30-year projection to show, as you can see on this chart, the annual reserve contributions, or how much the association should be putting aside each year into the reserves, what the annual expenditures are when it comes time to replace one of the common elements, and then it also shows, which we don't pay a lot of particular attention to generally, is how much money that association is setting aside over the 30-year life cycle period of the community, what the total amount of money that's set aside by the association would be. So, for example, in this one example I'm showing, it shows that over 30 years, this association would set aside $5.7 million just for the replacement of the components that are made up in the reserve study. But what's missing in this? Like I mentioned before, this reserve study typically makes up only 30% of the association's budget. So we need to start taking a look at what else goes into the budget and how you can use your reserve study as an absolute tool to help the association guide itself into the highest performance building available. So how do we do that? Let's take a look at the reserve study and now take it to what I think will be the way reserve studies will be done in the future, to take a look at not only the total cost of the components that are going to be replaced, but now let's add to that reserve schedule also for each of the components that are on it, any type of maintenance that's associated with those components, as well as the energy that's associated with these components, to take the total cost associated with this that makes up 70% of the association's budget. So what you're looking at looks very close to what you saw a few slides ago, which is the typical reserve study, or the physical analysis part of the reserve study, but now we've added the cost of energy and the maintenance for each of the components on the study. So what does this lead us to? If you take a look at this over a 30-year projected period, and for example, you have a few different categories to look at. And in this example, if you take a look at the total cost over 30 years, just for the replacement only, it comes to $9 million. But what's left out? We've left out 40% of the budget. So now let's add to that the additional cost in this example for not only the reserves, but also the cost of maintaining, maintenance, as well as the energy for the original components that were included on the schedule. Generally, when a community is built, it's built with, and there's not a lot of attention paid to the energy costs, especially in the past, as well as the maintenance that's necessary. So in this case, if you take the replacement reserves only, it's $9 million. But you take the replacement cost and now add to it the cost of maintenance and energy with the original components, the total cost over that 30 years would be $13 million. So it adds $4 million to the cost. So what do? When the reserve study is done, you take a look at it and use it as a tool, and for each of the components that require any type of maintenance or energy, instead of replacing them with the same type of components that were there originally, you take a look and say, I'm going to replace the mechanical equipment rather than with standard mechanical equipment, but high efficiency equipment. Or I'm going to replace the components that require a high amount of maintenance with something that requires a low amount of maintenance. So in this example, rather than paying $13 million over 30 years, it's cut down to only $8.5 million, not necessarily because of the cost in the reserves portion of the budget, but because of the significant reduction in the energy costs and the maintenance costs based on what you replace the components with. So in this simple example, you see that just by doing the replacements a little differently and using a reserve study as the starting tool to understand what makes up that 70% of your budget, which is the reserves, maintenance, and energy, over that 30-year period, the association can save $4.5 million just by using their reserve study as the starting point to make the replacements in a more efficient way, which not only will save on the cost of the energy, but will save on the amount of energy that's necessary. There was a quote made once that when a survey was done, that 98% of people want to see us use less energy and live in a greener world, but only 2% of them are willing to pay for it. This is a clear example of how, especially in the community association model, you really don't have to pay more. You can actually pay less for using less energy, and just based on how you make your changes, and you take a look at your overall budget rather than just a portion of them independently. Another area where associations can save money in the same vein is with deregulated energy. What is deregulated energy? In the state of New Jersey, it's just become very popular over the last year or so, where it's the opportunity to make your choice in who provides you with your electricity and your gas. So just to give you two examples, well, first of all, right now there are 14 states that allow for deregulated energy, and 18 are in the process of switching over to it. New Jersey is a deregulated state. But just to give you an example, generally for your common elements with your commercial meters, by switching, you could save up to 15 to 20% on your energy costs, and for the individual meters in the units, you could save up to 10%. Another area where you could save money. So what does this lead to? When you do your replacements out of your reserve study or any of the replacements in the community, the way it's classically been done is people look at the replacements and they look at how much will it cost to replace something just by the material and the labor cost, and they come up with the total cost, and then they say we're going to base our replacement on what's the least expensive to do. Our recommendation is, and I think more and more associations are going this direction, is to look at what's called the evaluated cost approach, where you not only look at the first cost of the components, but you also look at what is it going to cost you over the life cycle of your association, whether it's 10 years, 20 years, or 30 years, to add to your replacements the cost of maintenance and the cost of energy to come up with a total cost over a time period rather than at a point in time. And you'll find that, especially when you're dealing with mechanical equipment, that generally your decisions made in terms of what you're going to replace your equipment with will be changed just based on taking a look at the cost of the replacement as well as the energy used that's associated with that replacement. The other thing to take into account is rebates, tax credits, and some of these things were touched on in this presentation. But I will say that, for example, in the state of New Jersey, there are more incentives available for doing these type of replacements than any other state. And it's my suggestion that when you do replace any type of mechanical equipment, before you replace anything, you take a look to see what type of incentives are available. I just want to mention two examples, for example, in the state of New Jersey when it comes to this thing. The first is what's called a pay-for-performance incentive, which means that if you can essentially reduce the energy usage in your building by 15% or more, you can get up to $1 million per meter to offset the cost of any changes in the building to obtain that 15% savings. Now, it's a little more detailed than that, but it's a plan in the state of New Jersey called Pay for Performance, and I've simplified it, but that's what it essentially does. The only other one I want to mention is called direct install. If you replace any type of mechanical equipment, there's a program where, depending on what you replace it with, you can get up to 80% of the equipment cost paid for if you use an energy-efficient piece of equipment and you go through the direct install program in the state of New Jersey. So to summarize, my suggestion is that you don't just look at your reserve study as something that tells you how much money you should set aside to replace your roofs and your equipment, but you look at it as the absolute tool to help you maximize the performance of your building. And when I say maximize the performance, I'm talking about minimizing your cost of operation by maximizing that performance. And now I'd like to pass it on to our next speaker to talk about Christmas and Hanukkah funds.
Thank you, Mitch, for that succinct presentation.
Thank you. All right, I know that it is almost May, so people are probably thinking Christmas and holiday funds, but it'll be that time before we know it. We want to talk about the funds. And basically, what is a holiday fund? A holiday fund is building owners, the unit owners, shareholders often establish Christmas holiday funds for their employees. Rather than employees getting a lot of small gifts, there's a fund put together so that it can be distributed among the employees. The funds may be established whereby individuals contribute cash to a fund. Contributions may be based on suggested amounts or discretionary amounts. The fund total will be divided among the employees and given to the employees as a holiday gift. It may be distributed equally or on some other criteria, length of service, position of the employee. The amounts may be determined by either management or by a committee, the committee that establishes the Christmas or holiday fund. So the question is, are these funds taxable to employees? Well, the Internal Revenue Code definition of gross income says that includes income from all sources unless a specific exception applies under the Internal Revenue Code. Code Section 61A2 includes compensation for services, including fees, commissions, fringe benefits, and similar items. There is a code section, number 102, that excludes gifts from the definition of gross income. However, there's been case law that addresses it and states that the exclusion of gifts from gross income shall not exclude from gross income amounts transferred by or for an employer for the benefit of an employee. In other words, if there's a gift by an employer to an employee just by nature of their service as an employee, then it's not a gift. Rather, it's income. If it's income, taxable income, it must be included in payroll and it's subject to payroll tax. Well, so now we know that if it's a gift from the employer, it's subject to taxes. But is it a gift from the employer, or is it merely the employer collecting a lot of money from the different shareholders? Well, we need to determine whether or not the board or the co-op was involved. If the board, and by nature of the board, the co-op being involved, then it's more likely construed as from the employer and therefore taxable. So just because the employer, the co-op board, doesn't write the check, if the board is aware of the collection, there's public notices, there might be a flyer in an elevator reminding people about the holiday fund, something in the laundry room, collection boxes, then the board's aware of it, and so therefore it's considered possibly to be from the board. Also, if the funds are deposited into a co-op's bank account and then distributed, clearly this is running through the co-op's general ledger, their book, and it would be considered a gift from the employer. Another issue besides the taxability is about the distribution of the funds and whether or not it's appropriate. When monetary awards are not directed by management, then the award might not necessarily be appropriate. Is the amount of the holiday fund given to each employee based on job performance of the employee, or is it based on who the committee likes better or what individual has made it their point to get to know the committee? It also takes away the reward function from management. Management are the individuals that really know how each employee is functioning and who deserves more of a holiday fund bonus. And it may motivate some inappropriate behavior and activities that are not in the best interest of the association. Therefore, a lot of thought has to be given into who actually distributes the holiday funds and who makes the decision on how much each employee receives. Just to summarize, that any type of holiday bonus, if it's given to an employee and considered income, it must be added to the employee's payroll, and it's subject to payroll taxes, both by the employee and the employer. If a holiday gift is given to a contractor, which often happens, if the sum of money is over $600, then the co-op must issue a Form 1099. And that sums up what I have to say about holiday bonuses.
Yeah, the only thing I would add to it is, while this could be problematic, especially if you have a community that has been doing it the wrong way for a very long time, how do they change it back to the right way without everybody screaming bloody murder because you're cutting their compensation or the amount of the gift? But this is the reality. There is a right way and a wrong way. And I guess the concern is if you're doing it the wrong way and you're turning a blind eye to it, there's the potential risk that the IRS comes in and holds the co-op accountable for the income taxes that weren't paid on what was really deemed to be income to the employer. So it's one thing to look the other way and say, okay, somebody will get caught, but there could be an adverse tax consequence to the co-op if they're held responsible for the unpaid tax compensation. So I want to thank all of our speakers. I know it's late. If there are any questions, feel free to send them in. I don't see any right now, but you see the list of speakers up on the screen. Please feel free to email any of the speakers or me, and I can route it to the speakers, and we'll be happy to get answers for you and spread the word. The webinar will be up on our website for any of you to make reference to. So on that note, we thank you all for your attention. I thank all the speakers for doing a great job tonight, and we look forward to touching base with all of you again soon. Thank you.